everyone, and welcome to your Daily 5. This is Mish Schneider, Director of Trading Education Research for Market Gauge, and very excited to have this segment with you today because the market obviously has been in a very bad situation. However, rather than bring you just stocks to watch, I think this is an extremely important time to look at what I like to call the outliers, some of which you've heard me talk about a lot, and some might be new to you, but always huge key into what's going to happen next with the overall macro seen through these technical indicators. So the 5 instruments we're going to be watching right now are going to be the long bonds, the junk bonds, the sugar futures, the dollar futures, and the volatility futures. So let's go to the charts. So you can see here that I have the sugar up, but we're going to go right to TLTs first. We'll come back to that. Now, now I know those of you who saw ChartCon saw that Keith and I debated on the bull and the bear case of actual TLTs. So the reason why I'm so fixated on the TLTs, let's say, versus the 2-year or the 10-year treasuries, is that the TLTs have a couple of functions in that they have been the classic flight to safety, clearly not this year. And because they have a longer time frame, it's 20 plus years out, then it's possible that you might see any kind of relaxation from the Fed. And of course, it's possible that that won't happen, reflected here in TLTs. And then also from a technical standpoint, very interesting. So if we start here first with the actual price chart, we have been breaking down, and after we broke down underneath all this low from this point in time right here, that was back in June when we had that June low, we broke this down in the bond market. And even though certain instruments like the IWM, for example, the Russell 2000 are still holding the June lows, this clearly has not. So you really have an indication here that this has a lot of room even for a major short covering rally before it actually gets back to a more positive standpoint. But right now, we're not even worried about that because we can't even seem to hold back over 100. So right now, it would have to be, say, 100 to 150, even 101 that took out all of this work for us to start thinking that any rally in the overall market that's going to be sensitive, particularly to yields, can sustain. That doesn't mean we can't get a rally, but it certainly means that a sustained rally would have to be an actual change in the macro landscape given the yields. What's interesting here is that you can see, obviously, this is well underperforming the SPY, and that's the whole reason why those 60-40 portfolios have just gotten killed. In rough times, generally, this will outperform the SPY. But what I find most interesting here is that in the real momentum indicator here, that indicates the whole momentum, this low that we had here, which we've now gone below in price, in momentum is still holding. So we are seeing a little bit of a momentum divergence. I wouldn't exactly call it positive, but it does seem, and you can even look at it in the price action, that perhaps the TLT selling pressure has dried up. So one of the things to look out for is that we don't make a new low, we don't see a big drop in momentum, we maybe see this start to tick up a little bit versus the S&P, and most importantly, that we see the price improve. The next one, of course, is the other side of the bonds, which is the junk bonds. And the junk bonds are actually kind of interesting here because they, look at that, touched the low last week right on a Bollinger Band. And then they didn't exactly get a good reversal pattern confirmation in that we didn't get that close above the Thursday high on Friday, but we did pop above the Bollinger Band today. We could actually be getting a mean reversion to the sell side. That could be it. I mean, that's how active this market is right now. And even though we have been outperforming the SPY, we're heading lower again. And we did have a good mean reversion trade here, which gave you this pop. But we haven't really gone anywhere, even though, again, momentum is not nearly as low. So what you want to see with the junk bonds, I think, really would have to be a move over 90 to start. And when I say 90, it's an area. It's not necessarily exactly 90. But if you go back to these two lows here that I'm looking at here from June, It stopped at 90. It broke down under 90. We've tried to rally to 90. And now here we are today. We opened up higher, but let them tell you that high yield, high debt and long bonds may be relaxing a little bit for a pop. Then that would be more of an indication, perhaps, that we see a more sustained rally seasonally. On the other side, of course, if they can't do that, then I would take that as fair warning that whatever pops are going to be short-lived, and we've got way lower to go. Now, the reason why I'm so interested in sugar is because, and I know this may be repetitive to some, but sugar is a really interesting inflation indicator. It's also an interesting social indicator in that A, sugar is in everything, B, it's a food, C, it's tied to energy, and D, it's actually something that is in especially poorer countries being fought over right now because there's a shortage of just food in general, and a lot of the food with sugar in it. Now, in this country, of course, we're much more health conscious, but this would be an interesting indication that even in this country, things might start getting from bad to worse in terms of social unrest. Believe it or not, that's what this tells us, because in the 70s, it rallied long before the metals did. After we came out of a recession in 74, 75, 76, this thing went all the way up to 60 cents. Now, what you can see right now in prices, we're above the 200-day moving average. We're holding 18 cents a pound, actually more like 18.50, 18.25. You can see how well it's outperforming. In fact, it hasn't quite made a new, yes, actually it did make new highs in terms of its outperformance against the SPY. And if we take a look at here at momentum, it's also taking out the zero line. And if it has a couple of other times before, obviously in July during the rally. But what's interesting now is this is doing it when the rest of the market is not. So keep your eyes here. The next, of course, would be the dollar. Okay, I'm going to look at the dollar actually as UUP. It's not the futures, but it'll still be kind of reliable. And so the dollar, and what you can see here on this chart, and because I don't have all the Bollinger Bands and set up on my monthly chart, but if you look at the DXY chart right now, it's trading at around 112.20. And if DXY actually closes this month under 112, and considering it's the 17th, that might be considered a significant breakdown. And certainly we can see UUP is failing here after the peak. It's starting to test the performance against the SPY. And in momentum, we had a mean reversion to the downside after it peaked. We've held the 50, but now it's coming back down again. So if the dollar breaks 112 and UUP, I guess we could say probably the area would be more like right here at 30, it's possible that at first the market will go yay. But then you have to wonder if the other currencies like the yen and the pound and the euro have already taken a severe beating and the dollar's held up because America is perceived to be stronger than the rest of the countries and the dollar starts going down, is that necessarily a good sign? And finally, we're going to take a look at the VIX. So people like to use 30 as the key area of if it breaks 30, the volatility is coming in and the market could rally. And if it holds 30, then obviously it means that whatever pops you're getting in the market, they're going to be short-lived. What's interesting about volatility is this now is holding a Bollinger Band here at 30, holding and its outperformance against SPY. However, this too had a mean reversion trade, even when the market was trading higher than it is right now, and is about to test some interesting moving averages. So I would say if this breaks 30, we probably would go down to about 26, 27, but that would also mean that we could see another rally in the market. And if you know how to trade this market from a more active position, and you keep your eye on, obviously, the other indicators we just talked about, there is some money to be made, but do not underestimate the fact that we still have a lot of headwinds in the macro. Okay, that's it for now. Thank you so much for watching. You all have a great day. Bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.